Well, we've had extraordinarily benign conditions really for virtually all risk assets in the third quarter of the year, and it's really a continuation of the pattern we saw in the first half of the year. And I'm pretty confident that the sort of numbers we're now looking at in terms of returns from most risk assets are much better than most people would have predicted at the beginning of the year. So there's been a virtually unbroken upward movement in equity markets, almost without exception in the third quarter. Emerging markets doing quite a bit better again than developed markets. So far this year they've outperformed by over 10 percentage points against developed markets, which of course reverses the pattern of the previous 5 years. But interestingly, bond markets, although they've not been as strong as equities, have also done pretty well, with credit, high yield, emerging market bonds producing some decent returns again in the third quarter of the year. So really very benign environment, generally low level of volatility. The VIX index, the so-called fear index, at multi-decade lows over the course of most of this year.
Clearly one of the key positive themes we've seen over this year is an improvement in the economic conditions and generally positive macro. Is that the main contributor to these returns?
Without a shadow of doubt, and that's absolutely key to what has been happening here. There have been things to worry about, but underlying all of this all the time has been this steady pickup in growth. It's the first synchronized and now sustainable economic recovery we've seen since the global financial crisis in 2008. Very, very important. And most economies have done well. Probably the biggest and best surprise has been the Eurozone, which had been a real laggard, now growing at an annualized rate of over 2%. The US has actually done pretty well, continues to grow at about 2.5%. Looks as if anything, it's accelerating a little bit at the moment. And Japan, which has been very, very sluggish for many years, is also growing at close to 2%. And of course that, combined with what has been a very subdued inflation environment, has really helped the corporate sector in terms of profits. So we've had double-digit gains in corporate profits. That's been the key thing that's definitely pushed equity markets along. And the low inflation has meant that bond markets can also actually produce some modest positive returns as well.
The other consequence of a benign inflationary environment has been that central banks have had a lot of breathing space to keep monetary policy extraordinarily low. We look like we're on the cusp of an increase in tightening now. What do you see here?
Look, I think this is one of the great turning points in this cycle. As you say, we've had years and years since the crisis of ultra loose monetary policy, the huge monetary experiment, both very, very low interest rates, zero, in some cases negative interest rates, and huge asset purchases by all the big central banks. We're now at the beginning of a change in that cycle, and the most important central bank of all, of course, the Fed, has already pushed rates up by 2 or 3 times over the course of the past 12 months. It's now likely to push rates up again before the end of this year and further next year, as long as the economy remains growing at these sorts of levels. And for the first time since the crisis, we're now going to see a reduction in the size of its balance sheet. In other words, it's actually going to be effectively selling back to the market some of the bonds it bought. So in fact, over the course of the next 12 months or so, the QE program, the huge asset purchases of the big central banks, is going to diminish very significantly by about $100 billion a month. So by the end of next year, it looks as if we'll be in a situation where only the Bank of Japan is buying assets and the Fed is actually selling them back to the market. This is a very big change in liquidity conditions, of course, so it's something really to watch out for, and I think it raises the risks of policy missteps. So far so good, but there's some dangers involved in all of this if the Fed in particular engages in policy that's too tight, too early.
So there's been a clear change of direction in terms of monetary policy, and that's likely to continue and grow, of course. Have we seen a response from yields in government bond markets, for example, on the back of this?
Yes, we have, particularly at the short end of the market. In fact, over the past 12 months, the yield on the 2-year bond in the States has doubled to 1.5%. In fact, it's now back to the highest level since before the financial crisis in 2008. So I think that is pretty significant. The Fed is targeting 4 more rate rises between now and the end of next year. The market doesn't believe it's going to happen, but if that were to happen, then short rates would be 2% by then. Fed fund would be 2%. You can imagine the 2-year bond yield will be at least as high as that. So I think there's a pretty fair chance that we will see yields on bond markets continuing to go up. Fairly slowly. Inflation is not a problem. We're not seeing a typical cycle here where there's very strong growth, shortage of capacity, inflation picking up dramatically. But nevertheless, we are at the stage now where I think yields on bonds will tend to go higher through this cycle.
On the subject of things going higher and activity generally, turning to politics, Trump's reflation trade continues to disappoint us.
Yes, absolutely, because we started with a bang at the beginning of this year. Everybody expecting Trump's policies on tax reform, tax cuts, infrastructure spending, regulatory reform to really boost economic activity. So far, he has failed to deliver on pretty much everything. So the Trump reflation trade is priced out. Interestingly, though, towards the end of this quarter, we have now seen quite a significant proposal in terms of tax reforms, tax cuts, both at corporate and individual level. And there's a little bit of a sense that the Trump reflation trade is coming back in. Now, the big question is, will he get it through Congress? I think the answer is at least some of that. So it's turning a little bit more positive, having discounted that whole reflation trade completely. The market is beginning to say, well, actually, I think it might help growth in the next 12 months, and it probably will.
Moving from the world's major economy to Europe's major economy, Germany had an election and a bit of a surprise to the market.
It was a bit of a surprise. Interestingly, the sort of rise of populism and nationalism, which we thought was fading a little bit in Europe, particularly with Macron's election as President of France, re-emerged in Germany. And in fact, what happened is that Merkel and her coalition partners really got drubbed in the election. Their share of the vote was down a lot, the lowest share since the Second World War. And for the first time since the Second World War, the big move was that the far right, the AfD, has seats in the Bundestag, significant seats. It got 14% or thereabouts of the poll. So if that isn't a rise of populism, what is? It makes Merkel's position, she's secure as Chancellor, she's clearly weakened, and it makes her position in terms of trying to engage with Macron with structural and major reform across the EU, which we all know is required, is going to be much more difficult. 22% of the German electorate voted basically for far left or far right parties, neither of whom have a great deal of sympathy for further integration in the EU. So she's got a much tougher job ahead than she had prior to the election.
From a chastened Chancellor to a Prime Minister in dire straits as well. Tell us about the UK.
Well, it's been a disaster, quite frankly. The election, of course, was a mistake to have called it. The Tories lost a majority. They're now at the hands of small minority parties to stay in power. The Prime Minister has been absolutely chaotic. She's not in any authority in terms of her local cabinet ministers or the Brexit negotiations. Her days are clearly numbered. She won't survive too much longer by the look of things. And it does raise the question, it raises two big questions for the UK as it engages in really the most demanding negotiations with its international partners, the EU 27 that it's had since the Second World War. Will it be able to negotiate a good deal to come out of the EU? There's now talk of a lengthy transition period. There's a raised risk, I think, of a no deal being done by the time we come out of the EU in March 2019. And it raises, arguably more importantly, the real risk that the government collapses and we let in a hard left government led by Jeremy Corbyn, the likes of which we have not seen in modern political history in the UK. So I think the UK is going through a very tough time, and the UK assets have started to underperform the rest of the world. Difficult to see under these circumstances how they're going to turn that around, quite frankly.
Talking about assets underperforming, the one stumble we got over the quarter was when tensions rose over North Korea.
Yeah. Yes, that did produce a short-term spike in volatility. I think the big surprise to everybody was that North Korea has evidently developed a hydrogen bomb much earlier than people thought. Pretty dramatic event. And the rhetoric, of course, between two rather unstable characters, unpredictable characters, Trump and Kim Jong-un, have been pretty dire, quite frankly. The market's view and investors' view generally is that the ultimate sanction, a nuclear attack, is out of the question. Both sides, I think, recognise the complete damage that would cause. North Korea would be wiped out, parts of South Korea would be wiped. I think it's just not an option. So I suspect the outcome to all of this, and I think this is probably the market's best guess, is that North Korea will ultimately develop a nuclear bomb that is usable. And I think the international community will have to live with that, tighten sanctions, and it will mean that North Korea remains an impoverished nation through sanctions for many years ahead. It's a tiny economy globally. It doesn't matter. What matters, of course, is the risk of all-out nuclear war. It looks pretty remote possibility.
Yeah, in fact, that remoteness is reflecting the fact that the VIX index, the FIN index, is more or less at all-time lows still.
Absolutely, all-time lows. I mean, you would think at some stage that will blip up for some reason, because as we enter this period that we talked about earlier, where there's clearly a turning point in monetary policy amongst the central banks, a withdrawal of liquidity. Markets have gone up quite a bit in the course of the past 12 months. Certainly have gone up more than corporate earnings have gone up, so valuations getting a little bit high. Bond markets vulnerable to tightening interest rates, reduced liquidity. There are a few bumps on the way. At the moment, most people are pretty confident that inflation will stay low. If, on the other hand, the economies accelerate a little bit, inflation starts to pick up a bit more, central banks have to tighten policy a bit more dramatically, then there's a few concerns out there. So I wouldn't be surprised if we don't see the VIX index picking up a little bit, markets having some sort of a correction over the next few months. But the longer term outlook remains really constructive, because you've got this good, sustainable economic recovery going along around the world. And although monetary policy is turning, this is going to be a very, very gradual process. So I don't think we will see conditions which cause markets to set back dramatically. It's more an opportunity to add to risk in portfolios if we do get a shorter term correction.